Hello and welcome to Integrated Capital Management's third quarter Market Insights webcast. My name is Pete Seiler. I'm a part of our business development team here at iCM. In a moment, I'll be joined by iCM's Chief Investment Officer, Mike Paciotti, and our Director of Investments, Ryan Lehman. But before we jump into our material today, I'd like to take a moment on just a few housekeeping items. First, this webcast is being recorded. Therefore, all participants are on mute. The replay of this webcast will be sent as a follow-up to all registrants. And you may have noticed that we've upgraded to a new webinar platform for this meeting. As part of this transition, we included the option of submitting questions to us in advance of this webcast. It's included in the registration. We'll address the questions submitted to us by registrants at the conclusion of Mike and Ryan's prepared remarks. If you should have additional questions for our team, please, as always, never hesitate to reach out via email info@icm-invest.com, and a member of our team will be in contact with you in short order. So without further delay, I want to welcome Mike Paciotti. Mike, the floor is yours.
Thanks, Pete, and welcome everyone to our third quarter 2024 Market Insights presentation. As Pete mentioned, my name is Mike Paciotti. I'm the Chief Investment Officer for the firm, and I'll be joined shortly by our Director of Investments, Ryan Lehman, who along with Pete and I will be your hosts for today's presentation. So after a cold dose of inflation reality reset fixed income market expectations from 7 rate cuts in 2024 all the way down to 1 December cut, inflation and perhaps more importantly, jobs market data are now showing signs that the rate hike campaign that ended a year ago is kind of doing its work. So at least for the moment, the market is pricing in the possibility of 3 rate cuts, 2 with near certainty, the first happening in September, along with our still strong economy. So at the same time, earnings expectations are expected to be about 30% higher over the next 18 months. So folks, this is the definition of peak bullishness, right? Rapidly growing earnings in the presence of lower rates, which is a great scenario if it happens. The problem is that once it's expected, the results have to be even better to move that dial, meaning more rate cuts or even higher earnings. So while we do expect 2024 to be a good year for earnings, this expectation or peak enthusiasm, if you will, could be challenging. So now, as I kind of wrote in my quarterly letter, neither lower rates nor higher earnings individually are really remote scenarios. But when you take them together, it really kind of requires everything to go perfectly to plan to kind of manifest itself. So on the flip side, though, this is going to be a welcome sign to fixed income investors, providing really a much welcome boost to markets that have struggled since the first sign of rate hikes that emerged, believe it or not, almost 3 years ago at this point. So the opportunity on a risk-adjusted basis is about as good as it's been in the last 20 years for fixed income. So ironically, while equities are still pricing as many as 7 cuts, fixed income markets have barely budged at this point, perhaps the result of really kind of being burned earlier this year by similar optimism. So it's good news for investors who are looking to put cash to work, or nice rebalance opportunities for those that are already invested, but have ridden this equity wave upward. So over the course of the next 30 minutes, what we intend to get into, I'll get into a few important metrics the Fed is going to be focused on, specifically the dual mandate data points related to jobs and inflation. I'll then provide a brief update on the state of fixed income markets before turning it over to Ryan to provide an update on equities, real assets. So in particular, he'll cover kind of the valuation landscape as well as our expectation for future returns before closing with strategy positioning. And as Pete mentioned, we have a few questions that were submitted in advance, and we'll take a few more at the end via the chat function. So with that, let's jump into our presentation. And the first and most obvious economic data point that we'll cover is U.S. headline CPI. So after 5 consecutive increasing prints, as well as 5 above trendline prints for the Fed target rate, may really mark the first real turning point since the crack in inflation last fall. So as we discussed last quarter, core services, particularly shelter, had been the main driver of these hot prints, uh, which has declined to really a monthly rate of just 13 basis points, its lowest level since September of 2021. Core goods continued its trend of flat to declining prices, perhaps a better indication of what's going on in the broader economy in terms of inflationary trends, given that housing is kind of being influenced by two kind of dynamics, that's supply demand dynamic and the lock-in effect that's occurring with mortgage rates. And then last but not least, in May, we saw falling energy prices, which helps subtract 14 basis points. Now, keep in mind, these are not equally weighted, folks. The weight to energy is a mere 7% compared to about 36% for shelter and 18 for core goods. Now, June, which just came out a few days ago, but we have a little bit of an update on, June continued the trend of soft prints, actually posting a disinflationary reading of -6 basis points versus the plus 10 basis points expected. So the deflationary trend in core goods continued. And as we drill deeper, it was really driven by a decline in new and used vehicle prices, right? So, but the primary source of this soft print was really a continued cooling of the inflation in shelter, which added a mere 6 basis points to this number. So we have to go all the way back to August of 2021 for a reading this soft on housing. So in total, though, this was really a much needed change of direction and very positive outcome. So now an equally important consideration, and the second part of that dual mandate is what we're showing here, the labor market. So for perspective, we've taken this back all the way back to the mid 1990s. And what you should see is a trend range from, call it, 0 to 400,000 jobs added on a month over month basis using a 6-month moving average to kind of smooth this out. So the takeaways here are, number one, how strong the labor markets were when at the peak, X the immediate COVID recovery, the 6-month moving average was 816,000 jobs per month, or 5 million jobs created over a 6-month period, right? Just really, really tremendously strong. So what you could expect, of course, is that this is going to provide for an exceptionally tight labor market with lots of pressure on wages and inflation, which is exactly what we got. And then the second takeaway here is the trend from that peak until now shows the availability of jobs declining. And as we've mentioned repeatedly, this is kind of the canary in the coal mine for the Fed. And a few more months of these soft prints will likely be the final evidence the Fed needs for a September cut. Now, as I mentioned a moment ago, unemployment has recently started to tick up, which has sparked conversations about a relatively obscure rule called the SOM rule. Now, this obscure rule is very reliable and says that anytime the 3-month moving average of unemployment rises 50 basis points above the trend line, a recession has ultimately followed. So the current reading is about 43 basis points. So a move from 4.1% unemployment to 4.2% would trigger the SOM rule, right? So we're right around the corner from that. So I would kind of be cautious about this in the very near term, though, and how we interpret this time for a couple of reasons. Now, number one, while I do think we are headed in the direction of a recession, the SOM rule does nothing to speak to the depth of these recessions. And in our current circumstance, I think massive fiscal stimulus might, on the margin, keep you from tipping over if it's close, right? So if you just trigger that SOM rule, you might not get that immediate recession because of all of these external influences, in particular that fiscal spending. So I think the message that we should take out of this is kind of like the inflation cooling and the labor market survey data. We can add this to a growing list of signs that the economy is certainly slowing down. Now, the outcome of all of this has been really a roller coaster ride of rate cut expectations dating back to last year at this time. So this slide shows the expectation for the future path of rates for the year 2024, as was expected at each one of the dates listed along the bottom here. So last June, the market was expecting roughly two more rate cuts by the end of 2024 than the Fed's own dot plot prediction. So just after the dovish pivot in December, rate cut expectations for 2024 reached that rather ridiculous 7 rate cuts. Here we're showing 158 basis points of cuts, which you could see is the difference between the Fed futures and the effective rate. So that's a full 6 rate cuts plus a few ticks. In fact, the peak occurred just after the end of the year. So while aggressive cuts are always possible, 6 to 7 cuts would require a rather swift decline in employment and overall economic activity. So as you can see, this marked really peak optimism by the markets as the futures traded a full 3.5 rate cuts ahead of Fed expectations. Now by March, this was all gone, with the Fed and the market being in virtual agreement at that point. Now, as of the most recent June meeting, markets expect about 1 rate cut more than the Fed. To be clear, the market has fully priced in 2 rate cuts, getting you from an effective Fed funds rate of 5.33% to roughly 4.86%. Now, that was at the end of June. As of this morning, we have 2.6 rate cuts expected this year and 3.3 priced in by January of 2025. So the market is definitely back on that rate cut bandwagon, right? Now, this is relatively mild in terms of cuts. So you don't need a ton of really bad economic data to support that. You certainly need the trend to be going in that direction, but you don't need a ton of really bad data to kind of get you there. But to take the next step from 3 back to 5, 6, or 7, I think that's kind of a different story. You'd need much greater weakness to get there. So let's shift gears. We'll talk about fixed income markets. After a poor start to the year, rates were modestly higher across the curve during the second marking period, resulting in a flat quarter for U.S. Treasuries and correspondingly investment grade fixed income. So this leaves the Bloomberg Ag marginally lower for the year with a 71 basis point decline. Investment grade credit and muni bonds also posted kind of middling results for both the marking period and the year, both down, call it 0.5% in 2024. So not surprisingly, given the rally in equities, your more credit sensitive segments that carry a higher equity beta have led the way for both the quarter and year to date. So high yield munis have kind of been the belle of the ball, so to speak, thus far in 2024, gaining 4.14%, and U.S. high yield bonds gaining 2.58%, with cash also in the middle there, benefiting from those elevated yields that we've enjoyed for the past few years, gaining 2.61%. Now the laggard for the quarter, after a strong showing in 2023, has been emerging markets debt, losing 3.71% year to date, mainly the result of a stronger US dollar, which I'll get into emerging markets debt in a little bit in greater detail in just a few slides. So shifting gears, let's jump into fundamentals of fixed income and start by looking at treasury rates. So this model is a multi-factor model we use to assess the level of treasury rates, right? It's based on current economic conditions and is really more useful in predicting trend changes than anything else. So what we could see is that based on today's economic climate, the model is suggesting that rates should actually be higher by about 60 basis points than what we see at current levels. So this is reflected by the -2 sigma z-score of the residual, or basically the difference between the predicted and the actual. So what this is saying is that actual yields have varied from the predicted by a relatively large amount. So when these events occur, either on the positive or negative sides, it's an indication of a disconnect between current economic fundamentals and the level of the 10-year Treasury. So today, the way I would interpret that is that the 10-year is beginning to price in future economic weakness, lower inflation, and potential rate cuts. Okay. So now, as I wrote in my quarterly letter, Liar's Poker, the market is always telling us some kind of story, right? It's up to us as investment practitioners to determine if that story is reasonable. So the story being told here is continued weakening of the economy and somewhat lower future rates, 2 to 3 rate cuts. This story actually seems kind of reasonable to us from our vantage point. Now, I've addressed this a bit earlier with the SOM rule, but it's worth mentioning again, so I'm going to spend just a second or two on it. This slide shows the shape of the yield curve with recessions marked as the shaded areas. So when the blue line is below the dotted crossbar, the curve is inverted. And curve inversion not only impacts how you should position your portfolio, but it also has it does have an economic impact, pulling all rates higher along with the short end of the curve. So given the lock-in effect with people in low rate mortgages, it probably isn't what it once was as a clear economic indicator, but I would be reluctant to say that it isn't having an impact. I think the impact is just more muted and delayed, but is still prevalent. Now, from a portfolio management perspective, and after a quarter end, after the quarter end, the level of inversion has actually moved to a mere roughly 20 basis points between the 10 and the 2, and flat along the spectrum of the curve from the 2 to the 30. At the moment, this still favors a short duration position, but it's getting close, folks. It's getting close to a toss up where you should be really indifferent between short term and intermediate term bonds. So the last few slides I want to cover speak to two assets where we have divergent opinions on. So the first one speaks to high yield, and the panel on the right shows the changing credit quality breakdown of the high yield index over the years. So not surprisingly, given the strong economic backdrop and easy money environment that we've lived in for the better part of a decade, the higher credit quality segments in blue have increased their share of the high yield market marginally from about 67% of the index in the 90s to about 74% of the index today. So this has come mainly at the expense of the single B segment, with the junkier C's and D's remaining relatively small but stable parts of the index. So I mention this because some have argued that tight spreads shown in the left panel are the result of the higher credit quality of the higher credit quality nature of the marketplace. So while the story does have some factual evidence to support the narrative, the magnitude is so small that we really don't consider this justification for the very tight spread environment and really increased economic sensitivity that one embraces by investing in this segment. So therefore, this continues to be a space that we want to try to avoid. And then finally, and conversely, emerging markets local currency debt continues to be a favorite despite the flagging near-term performance and really given the strong fundamental backdrop that we see. So first in orange, the excessively strong dollar has really created a backdrop which should add about 200 basis points per year to emerging markets debt returns over the next 6 years. When you combine that with a yield to maturity of about 7%, and our expectation for the asset to deliver returns greater than 9% over the next decade, it kind of becomes clear why you would want to own the asset class. So now this also fits really neatly with a Fed rate cut narrative, as lower rates would be supportive of that dollar weakening environment. So that brings me to the end of my segment on the economy and fixed income markets. I'm now going to turn it over to Ryan to address equities and real assets. Ryan?
Great. Thanks so much, Mike. So despite the S&P 500 rising by over 4% on the quarter, performance was pretty mixed across market cap, style, and geography. In particular, it was really just mega cap growth names that performed well, while value stocks and small caps actually ended the quarter in a pretty negative territory. And more specifically, and I'm going to get into this in a couple of slides, leadership has been extremely narrow with really just a handful of stocks driving index returns. Now, if we look outside the US, we saw some similarities and differences between developed and emerging market stocks. In terms of those similarities, returns in both markets were hampered by a strengthening dollar, which approached all-time highs as we really started to see monetary policy kind of start to diverge across the globe. If we look within the US, we've got rate cuts likely coming in September or November. And then looking outside of the US, we're actually starting to see some central banks already embarking on their rate cut campaigns. Now, outside of that currency impact, returns were pretty notably different, however. We saw generally flat performance out of the MSCI EFA index. This was largely due to some political uncertainty in France. And then looking at emerging markets, stocks here actually advanced by more than 5%. And this really came on the back of strong Chinese equity market performance at the start of the quarter, and then pretty strong performance out of some Taiwanese tech names. And then just to finish up with real assets, commodities ended the quarter up just shy of 3%. And this was largely buoyed by precious metals prices, in particular gold and silver, which continue to benefit from an uptick in central bank purchases. And if we shift our focus to valuations, this quarter what I wanted to do was also take a look at earnings, and more specifically, how far earnings and valuations are stretched in relation to what we'll call a theoretical fair value. And what you're going to find today is that we've got both earnings about 40% above their long-term trend growth line, and then we have our CAPE ratio also about 40% above fair value or its long-term average. And while the overvaluation isn't at those extremes that we saw in kind of that late 2021 period or the late 90s, kind of leading up to the tech bubble, it is concerning because it's one of the few periods in history now where these two key components of equity market returns are actually both above fair value and pretty significantly so at the same time. So if we look back to some other periods in recent history when this has occurred, future results, they have not been encouraging by any means. I circled just a couple of them on this chart for reference. You found similar environments back in 1999 prior to the tech bubble. We saw a similar environment in kind of that 2006 2007 period leading up to the GFC, and then in 2018 through 2021 leading up to that big drawdown we saw in 2022. And I'm sure we're all aware that those preceding periods were a little bit disappointing for US large cap equity investors. So kind of just to dovetail off that, what I want to do next is kind of take a deeper look at these two components and then where they could potentially be headed as we look ahead. So if we start by looking at valuations, here we're going to do it through the lens of our multi-factor interest rate model. And what you're currently going to find is that the Shiller PE, it's about 34 times, while the predicted PE, according to the current shape and level of the yield curve, is about 25 times. So this implies that you need to see valuations decline by just about 26% from current levels to reach the level that's predicted by this model. And as you can see, historically, model's done a pretty good job of actually predicting valuations using these various rates across the yield curve. So I guess the question then is, what does this mean for investors? Well, it doesn't mean that equity markets need to decline by 26% overnight. That only needs to occur if we assume rates kind of remain where they are today and don't move. However, if rates do change, and not even to that large of a degree, we could start to see valuations much better supported. So for instance, just to throw one scenario out there, to kind of put us at equilibrium, we would need to see a decline of about 90 basis points at the 2-year point of the curve, and then about 30 basis points at the 10-year point. So essentially, we need to see the yield curve kind of steepen a bit. We could also find some middle ground, though, where rates come down a little less, but equity market valuation contracts, still getting you to a level that's deemed more fair value by this model. And in reality, the possibilities are kind of endless. But I think the real intuition here is pretty straightforward. Regardless, rates need to be a little bit lower, and valuations probably need to be a little less lofty than where they are today. Now, the second part of this equation we're trying to solve here is earnings. So what we're looking at on this chart, it's looking at ISM manufacturing new orders and earnings per share for the S&P 500. And I think what's really interesting is that the ISM data does a really good job of indicating, at least directionally, where S&P 500 earnings are headed about 2 quarters in advance. So what have we seen recently, and then what are we looking at today? Well, over the last few years, you're going to see this relationship. It's holding up really well. It tracks that strong rebound in earnings that we saw post-COVID, as well as that slowing growth that we've kind of seen lately. And now if we look at what new orders are kind of telling us today, you're going to see a bit of an uptick and then a pretty meaningful decline, which is very much out of line with analyst expectations over the next number of quarters, which they're calling for, give or take, about 12% on a year-over-year basis when we start to look out to the final quarter of 2024. And the way we would interpret this, it's essentially saying that things are likely to be okay from an earnings standpoint for the next quarter or two, but once we do start to get further out, the market may be kind of setting itself up for a little bit of disappointment, at least from an earnings standpoint. So to shift directions a little bit and talk about why valuations are so elevated today, and kind of hit on what I talked about on my first slide, what's been driving returns. Previously, the conversation has really been around the Mag 7, but more recently, it's really just a single stock, NVIDIA, that's really been getting all the headlines and really driving the S&P 500. And I think this slide does a really good job of explaining why that is. So just to start off, to give credit where credit's due, NVIDIA's earnings growth, which has been driven by AI demand, has been outstanding over the last year or so, to say the least. However, where we are from a valuation standpoint right now, we've gotten to pretty unsustainable levels, which really has the stock price to perfection. So if we look at the PE ratio for NVIDIA as where we stand today, we've got a trailing PE that's currently about 75 times, while the forward, which is probably the more concerning number, that's at about 50 times. And if we just put that into context, looking at the S&P 500 as a whole, trailing 12-month PE on the S&P is about 25, so 1/3 of NVIDIA, and then it's a little less than half in terms of the forward PE. So we've got the S&P 500 at about 23 times versus at 50 times for NVIDIA. Now, if we dive a little bit into the charts on this slide, on the left, you're going to see NVIDIA's weight in the index growing exponentially over the last 2 years, reaching about 7% as of late. And then on the right, we're going to see its extreme performance and how that's contributed to the S&P 500's total return. And I think it's really that quarter to date number that speaks to really how extreme this has become as of late. So this single name, NVIDIA, was responsible for more than 40% of the index's return in the prior quarter, while the other 499 or so stocks that make up the S&P 500, that they were responsible for the remainder. So to say that leadership has been narrow as of late is a little bit of an understatement. And just kind of staying on that note for one more slide, I think we can quantify that a little bit better even by looking at market breadth, which, as expected, has been incredibly narrow over the last year and a half. So under normal circumstances, we expect this statistic to be about 50% or so, because gains for the index are relatively normally distributed. You should have about half of the companies above the index and about half of the companies below. However, when you have just a few large names with outsized returns, you end up with what we're seeing lately. We have just a quarter of the stocks outperforming the index, while 75% are being essentially left behind here. And a stat that's not on this slide, but a little bit even more troubling, is if we look at what's gone on thus far in 2024, we actually have about 37% of stocks actually in negative territory, despite the index rising by over 15% year to date. Now, last couple slides, a little granular, talking more about individual stocks. So let's take a little bit of a step back here and look at what this has meant for asset class performance as of late. And I think the story here is pretty straightforward. To outperform, you wanted to own U.S. stocks over international, you wanted to own growth over value, and you wanted to own large caps over small caps. Or kind of put all that together, you wanted to own U.S. large cap growth stocks, something we probably all know at this point. So here, what we're trying to do is just quantify this outperformance a bit by looking at those three asset class pairs and then their relative 10-year returns. And what you're going to find is that over the last 10 years, you're going to see underperformance for value, small caps, and non-U.S. equities as well, all at or approaching historical extremes. So if we quantify that by looking at it in terms of percentiles, you're going to find that small cap underperformance is in the 9th percentile, and this data is dating all the way back to the mid-1980s. Non-U.S. underperformance is in the 15th percentile, and then value compared to growth is actually in the bottom percentile. So it's really never been this bad historically in terms of 10-year performance for value stocks versus growth stocks. And as you'd expect, this has had a pretty meaningful impact on valuations, which we're going to touch on in the next couple slides. So if we start off with value, if we look at the 10-year CAPE ratio, we have the relationship versus growth stretched to more than 2.5 standard deviations after coming in pretty meaningfully following that pretty big spurt of 2022 outperformance. So for anyone who feels like they may have missed the opportunity after 2022 to kind of catch value at a historically cheap valuation level, we are essentially right back to where we ended 2021. And to tie this back to potential future outperformance, if you look at the slide on the right, in just about all periods when values traded one or more standard deviations cheap, it has outperformed growth over the preceding 10-year period, and in many cases by a pretty outsized amount. Now, the one bit of pushback value investors tend to receive kind of about this whole idea is around the concept that growth should trade at more expensive valuations because you're paying up for higher earnings growth. And in theory, this should be true. And for much of the last few years, it has been, especially with what we've seen out of the Magnificent Seven stocks. However, as we look ahead, the argument starts to lose a little bit of credibility, which is what's illustrated on this slide. So what we're looking at are earnings growth expectations according to S&P for various sectors going all the way out to Q4 of 2025. And what we see is that when you start to move out beyond kind of 2024, earnings per share growth expectations for traditional growth and value sectors, they all kind of tend to converge on the S&P 500. So that advantage that growth has had is expected to really start to diminish. And the question is, what implications does this have for asset allocators? Well, we just saw that from a valuation standpoint, that value stocks are about as relatively cheap as they've ever been. And then on this slide, we're looking at pretty equivalent earnings growth expectations for both growth and value stocks, or at least kind of those key sectors in both indexes. We'd say this bodes really well for future relative returns, and it really makes it a good time to start thinking about shifting your U.S. asset allocation toward value if you haven't done so already. And a bit later, we'll kind of quantify all this into exactly what that potential return differential could be. And then if we move on to small caps, just to touch on them here, that run up in NVIDIA and the rest of the Mag 7, that's essentially killed the small cap premium for much of the last decade. If we look at valuations, we went from slightly expensive in mid-2021 to near 1 sigma cheap today, and historically from levels that exceed 1 sigma, there have been few, if any, periods where small caps went on to underperform large caps over the next decade. Now, from an asset allocator's perspective here, one thing to keep in mind is that before jumping all in on small caps are still kind of in that fair value range, so they aren't necessarily cheap yet. Additionally, small caps do tend to be more economically sensitive than higher quality large caps. So if there is a potential recession on the horizon or a little bit of an economic slowdown, it could mean that small caps may take another leg lower before truly becoming a great buying opportunity. That said, though, it's not a bad time to kind of get this asset class on your radar because valuations look relatively attractive and they have underperformed meaningfully over the last decade. And then lastly, looking at non-US markets like value, like small caps, story here is very similar. Here we're looking at price to trend line earnings. You're going to find, again, valuations at some of their cheapest levels on record. If we look at international developed value stocks, you're about 30% undervalued versus their own history. If we look at emerging markets value stocks, you're closer to about 50% undervalued. And then comparing that to US stocks, we've got US stocks at about 35% overvalued on this same metric. Now, big difference here between international stocks and style and cap within the US is that being US based investors, currency, in addition to valuation, is also going to play a role in our expected return. So why don't we go ahead and take a look at what currency outlook looks like for these two assets. And here what you're going to find is that the dollar looks overvalued really however you slice it. So on the left, we've got a more fundamental look at the dollar using purchasing power parity, which is what it does is it essentially estimates how much the dollar's value needs to change in order to equate goods prices across currency regions. So here you're going to see the dollar looks overvalued by about 30%, which is its most expensive level since the 1980s. And then from a more technical standpoint, if we look at just simple price trend analysis, we've got both developed and emerging currencies currently trading at more than a standard deviation below fair value, which again, some of the cheapest levels on record, which here we go back to the late 1990s. And now when we think about what impact this may have on future returns, just to get back to fair value, you could easily see currency appreciation adding an additional 2% per year for the next decade, if not more, to international equity and international bond returns for that matter. So just to touch on some non-traditional assets really quickly. So usually we reserve this section of the presentation for commodities, but today I wanted to hit on closed-end funds, which at the end of last year were approaching pretty near historic valuation levels. Now they have done really well thus far in 2024. They've come in a bit, but today we do still have discounts sitting at around 6% below NAV for the universe as a whole, which is going to be wider than the long-term average, which is going to be closer to about 4. Now, one thing that I want to make note of here, I think that's really important, is that discounts vary pretty widely by asset class. So most notably, discounts for taxable bond funds, you're relatively tight there. You're actually inside the long-term historic average. But if we look at municipal bond funds, the average muni bond fund is actually trading at a discount of more than 8% below NAV, or more than 92 cents on the dollar, which is more than one standard deviation event, talking statistically. So what this does is it creates the potential for really attractive future returns from these levels, especially when we consider the yield advantage these securities offer versus traditional stocks and bonds. And for anyone interested, I will be talking about closed-end funds in a lot more detail on our call next Thursday. So if you haven't gotten an invite already and registered, be sure to keep an eye out for that. And then just to tie all this together, let's walk through our asset class return forecast and some strategy positioning. So here we're going to see our return assumptions for a variety of equity asset classes and how those have changed since last quarter. So starting with US large caps, you're going to see an expected return of just about 3%. This is well below the long-term average of 10 to 12%. And at this point looks pretty attractive on a relative basis, not just versus a lot of the other assets on this slide, but even versus investment grade bonds at this point. And then if we dig into the US, return expectations are pretty meaningfully skewed across growth and value, which should be expected based on what we talked about earlier. We've got value stocks expected to return about 5.5% over the next decade versus less than 1% for US large cap growth stocks. Now, small caps, a little bit higher than US large caps with a return of over 5%. But like I alluded to earlier, it might be a tad early to go all in on small caps at this point, just given the risk reward there. And then if we look to the far right-hand side of this chart, here we have our standout non-US equities with double-digit returns. Big driver of this differential between non-US and US assets is going to be what we talked about a few minutes ago, valuations and currency, both of which favor non-US assets versus US at this point. And then next, an interesting chart that I think is worth showing given the current environment. So this measures what we refer to as diversification alpha. So this is essentially the potential benefit that owning a diversified portfolio could create for investors versus owning just a simple 60-40 portfolio. And for the sake of time, I'm not going to get too deep into the weeds on how this is constructed, but feel free to reach out to a member of the advisor services team, and we'd be happy to go as deep as you'd like on this. But big takeaway on this slide is that given that the current low potential returns for U.S. stocks, from our viewpoint, it's essentially the most opportune time in about the last 20 years to consider owning assets outside of U.S. large caps. This includes within the U.S. owning some of that cheaper stuff like value over growth, but especially including things in your portfolio like emerging markets, commodities, international value equities, things like that. And this directly translates into strategy positioning just to kind of tie everything together. So we've got pretty sizable underweight to U.S. stocks. And then within U.S. or most meaningful tactical positions, it's going to be an overweight to U.S. value, with that value positioning being pretty largely focused on those attractively valued, deeper value and higher quality names. Then outside of the U.S., we have pretty meaningful overweights in both international and emerging markets value, as well as an out of benchmark position in commodities. Then if we look on the fixed income side of the equation, we have an underweight to duration, pretty neutral sector exposure. We changed this a bit earlier in the year. We had been carrying an overweight to investment grade corporate bonds. We did reduce that due to the meaningful spread compression that we've seen over the last year or so. And pretty consistent with that, we've got no exposure to high yield right now, where spreads are even less appealing than in the investment grade space. And then lastly, you're going to see that out of benchmark position in emerging markets, local bonds, another asset class that does have the potential to benefit from a weakening dollar. And with that said, that concludes all our prepared remarks. Pete, why don't we go ahead and cycle through the questions that we got for today?
Absolutely. Thanks, Ryan. As I mentioned before, for this event and going forward, registrants will have the opportunity to submit questions at the time of registration, and all of those will be addressed as they are received. So for this particular webcast, we received 2 questions in advance. The first one, if the Fed is on target to cut rates later this year, are there any potential negatives you see to such a move?
So Ryan, I could take this one
Yeah,
if you
go
want.
for it.
Well, I guess it's the great question, right? So we're kind of fixated on this soft landing or no landing scenario. So there's always a risk, right? So the risk is if you cut too early and the economy is really stronger, and you're, as we've talked about over the last year, producing at levels that are maximum productivity and at near full employment at this point, you really don't have anywhere for that to go other than into inflation. Conversely, if you wait too long, then not only do you end up with a recession, you could end up with, potentially bad one, right? There's a lot of variables that are really twisted in terms of external influences. Housing is one of them, right? We don't know exactly how housing is going to respond when the Fed cuts rates. The conventional wisdom would be that house prices will go up, but you're also going to unlock a potential wave of sellers that are kind of locked in those low rate mortgages. Now they could get out, that supply comes in the market. So you have all these imbalances that we're kind of working, we're kind of looking at. And I guess there are negatives to waiting too long and cutting too soon, but I think it's more related to our perspective on this, that we're trying to get this perfect soft landing, right? Historically, the Fed has always viewed recession not as a negative outcome, but almost as a policy tool, right? If inflation gets too hot, you could just tip the economy into a recession, and then ultimately you end up with, you end up cooling inflation off. I think we just need to keep that in mind, that a perfect landing is really unlikely. In fact, I don't think it's happened before historically. That if we get close, a little bit of recession, a little bit higher inflation, I think that's a pretty good job that's been done by the Fed in this environment.
Thanks, Mike. Second question, it's actually two parts that, and this was submitted just the other day. Do you think the recent assassination attempt on Trump has had an impact on markets? Overall, do you have any concerns for the market because it's an election year?
Yeah, Mike, I'll go ahead and take that one. So I think a very relevant question because we've got a lot going on, especially with the assassination attempt that happened over the weekend. So I'm going to try to be very as apolitical as possible here. So after everything that has happened, you got the assassination attempt, and then the debate about 2 or 3 weeks ago. At this point, it is looking more and more likely that President Trump is going to win in November. So if you just look at the betting markets as of yesterday, they had Trump at about 70% odds of becoming president. And you're starting to see the market kind of price some of that in. And I guess the question is, what does that potentially mean? And I think it's got impacts kind of on both sides, on the bond market and on the equity markets. So starting with bonds, what we are starting to see is the yield curve starting to steepen a little bit. And the expectation would be that you are probably going to see that steepen a little bit more. And we've kind of seen that even since post-debate. The yield curve is steepened by about 20 basis points or so. The reason being is that what a Trump victory essentially ensures is that you're going to get a renewal of the Trump tax cuts. You're likely going to get additional fiscal spending because of that. And all this, in theory, should mean higher inflation in the future and then higher rates kind of at the long end of the curve as a byproduct of that. Now, if you think of what that potentially means for equity markets, I would say it's likely going to have a positive impact on value-oriented sectors. So you think about kind of what are the biggest or the sectors that are most typically affiliated with or thought about in terms of value investing. Financials would be one. So if we think about the banking industry, you're likely going to benefit from that steeper yield curve because it's going to help them in terms of the loans they're making. And then also you're going to potentially see some relaxed regulations. And then if you think about kind of energy, materials markets, companies here, you're likely going to see a shift away from the current green energy initiatives, which are likely going to benefit the companies that are involved in the fossil fuel industries. And then lastly, just kind of thinking outside of the U.S., I think the primary risk is probably around the dollar, which could see some continued strength if Trump continues with these kind of tough talks on tariffs. That said, though, I think what's interesting is that if you think about his prior presidency, he tends to use tariffs as more of a negotiating or bargaining tool rather than something that is actually implemented to the same extreme as he talks. If you look back to what happened in 2016, initially you saw a big spike in the dollar and then a pretty meaningful reversal thereafter. So I wouldn't be shocked to kind of see a similar story play out again. And then thinking about just kind of like what this means or what an election year means potentially for the market is typically leading up to an election, you have seen a little bit of an increase in the VIX, a little bit of an increase in market volatility. Reason being the market doesn't like uncertainty. If we look back at what election years have done historically versus non-election years, you're basically within the margin of error. Investors have typically received the same return they have in non-election years versus election years. So unless something unforeseen occurs, the market just likes certainty. So I would not use the election year, rather, regardless of who you're going to vote for president or what you think the outcome is going to be, to kind of sway your current investment outlook or the way your portfolio is positioned. I would say just focus on the long term because over historical periods, there really has not been a difference, and investors are just better off staying invested.
Thanks, Ryan. Thank you, Mike. I also want to thank all of our participants today for joining us. As always, if you'd like additional information or have other questions, please do feel free to reach out to us by phone at 888-426-4689 or via email at info@icm-invest.com. We do hope that you'll be joining us on July 25th at noon Eastern Time for our Tice and Tice Alpha Opportunities Strategy webcast. Be on the lookout for your invitation to get registered for that event. And with that, we will conclude today's webcast.